Hello, Sharif.
Hi, Rana, how are you?
Good. Sharif, I have a question for you.
Sure.
There are different programs like the 3-2-1, 4-3-2-1, 2-1, and 1-0. Can you educate us about what are these and how can buyers use them?
Sure. This is called the buy down program, and it has different kinds, like say 3-2-1 or 2-1 or 1-1 or even 1-0, meaning if the interest rate in the regular interest rate is 7%, for example, the 3-2-1 means the first year they're gonna reduce the interest rate from 7, they reduce it 3%, so it's gonna be 4%. The second year or the second 12 months, it's gonna be reduced 2%, so it's gonna be 5% the interest rate. And then consequently the third year is going to be 6%, and then the fourth year is going to return back to the normal interest rate, which is the 7%, the one we signed on. This is and the same concept with 2-1 or 1-1. It helps to reduce the interest rate in the first 3 years or 2 years, because the interest rate right now, when it is a little bit high, we are expecting to go down in the next couple 3 years gradually. So at that point you can refinance with the better interest rate, with the better terms. That will help during this first 3 years for the monthly payment. Basically the difference in the monthly payment between the 4% and the 7%, of course, let's say if it's 7%, the monthly mortgage is $3,000. At the 4%, the monthly mortgage is like $2,500. I'm just giving simple numbers, for example. Who is paying for that difference? Basically, either one of the two things, either the seller is contributing into this, or there is some programs which is the lender can help with that, or it can be split between both. That actually can help a lot with this kind of programs.
Help me understand. Does it mean that if the seller is contributing to the buy down, it's like the seller is putting the money in a fund and they are funding the difference in the interest rate?
Yes.
So it becomes easier on the buyer.
Yes, it's kind of like in the beginning when the buyer and the seller they sign the note. There is an escrow account for that. Automatically, of course, it is calculated. There is like 25,000-30,000, for example, left on the side for that escrow account to fund that difference every month. And when you refinance, let's say if you refinance early, this money is available to you to be added to your principal.
Excellent. So you do not lose the money in case you decide to refinance.
Yes, you don't lose
Excellent.
the money, yes.
Thank you, Sharif.
You're welcome.